Joining us this morning, Anthony Saccaro, president at Providence Financial and Insurance Services. Anthony, great to have you back on the show. Now, you sent over some notes and you posed a question. So I'm going to ask you your own question because you didn't answer it for me in the notes. You say the open question is whether that's the start of the bubble popping or a healthy rotation when we're taking a look at the markets. Are we in a bubble or are we in a healthy rotation?
Well, it is a good question. It is somewhat open-ended. And when you're talking about the bubble, it's not so much just the markets as much as it's tied to AI. The AI concentration right now is much larger than I think a lot of people think. AI and a lot of the big name tech stocks that are really driving the S&P 500. The fact is that over half of the 500 companies in the S&P 500 are tied to AI in some major way. When you look at things like the Schiller Index, the cyclically adjusted price to earnings ratio, the CAPE Index, it's sitting right now just off of its all-time highs, which it reached in 1999, right before the tech crash. The simple fact is that its 145-year long-term average is somewhere around 17 or 18, and this is not an index that is talked about a lot, but it's very, very high, and it shows us that we are very, very overvalued at this point. When you look at the momentum trade, the S&P 500, the momentum ETF went up, I think, 45% in the last quarter, and the first couple of days of this year, it's down 6%. We have this massive momentum trade that's going on. This FOMO is happening. It's not happening in the institutional side. It's happening on the retail side. When you've got guys like Ray Dalio coming out and saying, hey, we're betting against the AI trade, and you've got all the retail people getting in, it smells a lot like we have a bubble coming up. And it's not just individuals that are in the Mag 7, which, by the way, is down year to date, right? The Lag 7, it's not just those people that are going to get hurt if and when the bubble pops. It's going to be everybody who thinks they're broadly diversified in the S&P 500 because those stocks are dramatically tied to AI. So it's not just about the tech stocks in and of itself. AI bubble pops, industrials go down, workers get laid off, construction goes down, housing's not good. It has that ripple effect. And it kind of smells like we might be headed in that direction.
So if we're heading in that direction, Anthony, then where are you looking at for opportunities? Because you said the worry here is that people think they're diversified and they're not. So if you want to stay diversified, where are you seeing those opportunities?
Well, when the tide sinks, all the ships sink with it. So it almost doesn't matter where you are in the stock market. Just like the tech crash of 2001 drug everything down, the crash of 2008 drug everything down. If you're not concerned about a bubble at all, and this is something that you think just doesn't make a lot of sense, and you're not worried about that, or maybe you don't care about the bubble with your phase of life, then I think you want to stick with things like maybe industrials, which are going to benefit from this AI craze that's continuing to grow. We know AI is here. It's going to keep going. It's just, are we in a bubble? Will it take, a 40 or 50% step back in the market before it moves forward? If you are worried about it and you still want to stay in stocks and you can afford to do that, then maybe we think about things like healthcare, which we know is going to keep pace with inflation. It's a non-discretionary sector. Real estate, same thing, non-discretionary. Pretty good in inflationary times because companies can raise rents and so on. If you are worried about the AI craze and you want to get out, maybe you start thinking about income-producing investments like preferred stocks or maybe even some bonds. Shore up, take some of the chips off the table, shore up some of your winnings, get some interest and dividends along the way, and regardless of what the market does, you'll be okay. And if you're retired or close to retirement, it's probably a good strategy.
And you hit on real estate there because of the inflation play, but with healthcare, do you think healthcare can continue to outperform as we've seen people moving into a more defensive play with healthcare, even if inflation stays elevated?
So healthcare is driven by several different things. And one of the strongest reasons that healthcare has outperformed is because of some of these GLPs. The weight loss medication, I don't know that it's going to continue to outperform to the pace that it has, but I do believe that it's still a good place to park some money. It's still a good inflation adjuster. The healthcare, this GLP craze is not going anywhere. GLP was initially designed to help other things like cholesterol and diabetes and other medical conditions. And then they found out that, oh, by the way, you can lose weight off of it. It wasn't never even made for that. So there's a lot of clinical studies going on, as far as I understand, for these GLPs that have a lot more to do with weight, a lot more to do than with weight. So it's still there. I think it's still a good defensive sector to be in if, in fact, you're worried about other components of the market.
And as you're looking at inflation as it ties to the Fed's dual mandate and the jobs data that we got on Thursday instead of Friday last week, how are you looking at their path moving forward? I mean, we know we have elevated inflation. We're perhaps, depending on who you ask, starting to see some potential cracks in the labor market. How are you looking at it right now?
Well, Kevin's in a bind, having been hired as the Fed head to lower rates, and he's just not able to do that. With inflation elevated the way that it is, right now the odds are greater for a rate hike this year than they are for a cut. And it has to be that way. The dual mandate is inflation on the labor market. Labor market's not the problem right now. It's inflation. And it's not just energy-driven inflation. The price of oil has come down significantly with the recent developments in the Strait of Hormuz and everything else. But core inflation is up as well. So it's a broad-based inflation. And sure, energy has something to do with it. The tariffs have something to do with it. The fact that GDP had a strong first half of the year has something to do with it. But that's expected to slow down. But right now, they can't lower rates. If they lower rates, they risk inflation getting out of control. And yet they still have to keep an eye on the labor market. Not a problem. But they have to keep rates at least where they are. That's what they should do in July. And then look at rate hikes if inflation doesn't cool down before the end of the July meeting.
And Anthony, of course, the hope had been for a soft landing, but we're starting to have more and more conversations about potentially moving towards what could be described as a stagflationary-like environment. I know Liz Ann Saunders likes to call it stagflation with a lowercase s. Do you see us more as entering a potentially stagflationary time, or do you think a soft landing is still possible here?
Well, it could be. The reality is that stagflation is, really no economic growth with inflation. Well, we got the inflation side of things covered, but is there going to be economic growth or not towards the latter half of this year? That's still up for debate. The estimates are all over the place. I've seen negative growth as estimates. I've seen positive growth as estimates. It's still a likely scenario that we do have stagflation. The simple fact, though, is that the market's still growing. That's why inflation is growing there. And I think we have to understand, too, that it's not growing so much because of the retail consumer spending money. It's a lot of the businesses and the CapEx that's being spent that's causing the economy to grow. And if that stops, if the AI spending slows down, then stagflation could be a real possibility. But it's yet to be seen.
Anthony, always great to have you on the show. Really appreciate you joining us on this Monday morning. Anthony Saccaro, president at Providence Financial and Insurance Services.